Hello students. So very good evening to all of you students. Now students, please tell me one thing. How was your paper today? Amrita, good evening. Naseem. So all went well. Elective paper SCMP I came to know was very lengthy this time. So it all boils down to students now your last two papers. Again I am repeating one couple of important point, and which is about the fact that please do ensure that when you attempt your examination question, the last two paper, don't start with the MCQ particular part, because as you all are aware, the MCQ unnecessarily will take a lot of time in the entire process. So my humble suggestion to all of you would be to avoid starting with the MCQ particular part. Choose two descriptive questions which can be other than the question number 1, because question number 1 would also be a bit lengthy. So any other two descriptive question, do them thoroughly, write the provision properly, and thereafter then you can jump to your MCQs and the other particular part. Just keep that in mind, because attempting maximum should be your entire goal and your focus so far as your balance papers are concerned, and this is a strategy which really works to at least help you to add on to that extra 5 to 10 marks. So that is the point, students. Now students, you tell me now in this context, let's start with this one. Now the first particular part, students, which I'm going to start off here, students, I hope that part you have referred the English part A. There was only actually one video which was there. In that one video itself, there was Hindi first 2 hours and English next 2 hours. So I hope that all of you would have referred the English particular part of the next 2 hours, which actually what I did was to do with the PGBP particular part, the sectorial deductions and everything. So that is what primarily I have dealt with it in that particular context. Now students, coming on this particular area, partnership assessment. For now students, partnership assessment, a question that could be there would be a total income question so far as your examination is concerned. So your question number 1 could be a total income question. Secondly, students, the important point as far as partnership assessment is concerned, there is no alternate tax regime so far as partnership assessment is concerned. What you only will have, students, would be only the alternate minimum tax, AMT, provided the partnership firm is subject to the 35AD deduction or it avails that profit link deduction, as the case may be. Only then we will find this particular scenario of the partnership assessment. Is that clear to all of you, students? So that is how the things has to be looked upon. Now coming back to this particular discussion now, students, over here. So far as partnership total income question would be concerned, students, my suggestion to all of you would be that you should ensure on one important thing, and that is about try to attempt initially when you have to solve that total income question. See, every adjustment carries marks. So your approach has to be first try to do those common adjustment like depreciation, like TDS not deducted disallowance, 40A3, 43B. All those adjustments should be done first. This remuneration and interest deduction in relation to the remuneration and interest should be referred a bit later on. So that should be the approach and that should be the technique. Now if you all see on this context, let's see for the partnership firm, so far as deduction of interest and remuneration is concerned, the authorization in the partnership deed, students, is must. I think all of you are aware of that. That is for sure. So you sometimes what happens is that, say for example, they will give it to you in the question that the deed has authorized to pay the interest on the capital and the current account. And one of the information in the question would be that the firm has taken a loan from the partner and has paid 10% interest to that particular partner. in that particular case, students, you have to simply ignore. In that particular case, you have to simply ignore, meaning thereby it is disallowed. It is disallowed. Why? Because payment of interest to the partners out of the partner's loan is something not authorized in the partnership deed, and that is a reason of disallowances. Is that clear to all of you, students? So this is how you have to be very careful on that particular part. Secondly, students, the authorization that is required should be prospective. So some question are there wherein they will say that the authorization was not done initially and only during the current previous year that the authorization has been done. And that is the reason why then you will have to ensure that if supposingly from 1st of July 2021 the authorization is there for the firm to make the payment of interest in the partner and the remuneration, then only 9-month interest, and that too at the rate of 12% per annum maximum, is what would be allowed as deduction. Only 9-month interest, and that too at the rate of 12% per annum maximum rate of deduction is what would be allowed. Third, students, is about the fact that the partners which are being covered here, if you see for interest, both the working as well as non-working partner is there, but as far as remuneration is concerned, it's only the working partner. The fourth, and that is an important one, scope of the applicability of the above condition. This I have already discussed, that the partnership deed should authorized for everything, only then the deduction would be allowed. If few things are not authorized, then those deduction will not be allowed to the SSE. The next part, this is an important one, explanation number 5, students. Explanation number 5. Now, so far as explanation number 5 is concerned, students, this explanation which is there, students, this is a case wherein the HUF is a partner in the partnership firm and the firm has taken the loan from the Karta but in his individual capacity. The HUF is the partner in the partnership firm, but the loan has been taken from the Karta, and that too in his individual capacity. In that particular case, students, neither the condition of 40B nor the limit of 40B will be applicable in this case, meaning thereby the entire amount of interest expenditure will be allowed as deduction. The entire amount of interest expenditure will be allowed as deduction. Please be careful in the question, it can also be vice versa. Vice versa means the individual is the partner, but the loan has been taken by the firm from the Karta. In that case also, neither the limit of 40B nor the condition of 40B would be applicable. A full deduction of interest expenditure will be allowed in this case. So that is how it has to be looked upon in this particular scenario, students. The next particular point, students, okay, by the way, I should tell you one more thing. If you see in AOP and BOI, there is a disallowance of 40BA. In the AOP BOI, whatever is the remuneration and interest which the AOP or BOI is paying to their members, full interest and the remuneration is disallowed under 40BA. However, there also the same point is there. For example, if the member is the HUF and the loan has been taken by the AOP from the Karta of the HUF, but in his individual capacity, then in that scenario, the disallowance under 40BA will not apply, meaning thereby full deduction of that interest expenditure on that loan amount will be allowed to the SSE. Now, so far as the limit is concerned, students, if you see the limit particular part, interest we all know it is 12% per annum, but so far as the remuneration is concerned, there is a case for a book profit. So you have to then see the range of the book profit, and I think all of you are aware, from book profit from negative to 3 lakhs, the maximum remuneration that could be paid is rupees 1.5 lakhs or 90% of book profit, whichever is higher. 1.5 lakh, students, or 90% of book profit, whichever is higher. Okay, and on the balance in excess of rupees 3 lakhs, whatever is the remuneration that has been paid, 60% of the balance book profit, 60% of the balance book profit is what is allowed as deduction. Now here, students, an important particular part is what is book profit. I think all of you are aware of the fact that the book profit would mean the PGBP under section 28 to 43D, but before the remuneration particular part. Isn't it? So this is one thing that you have to be careful about the book profit. What does it imply? It implies the PGBP under 28 to 43D, but before the remuneration part. Now students, there could be a twist in the examination question if they also give it to you the information relating to the UAD and the brought forward business loss. There can be a twist in the question, students, if they also will provide to you the information relating to the UAD and the brought forward business loss. Why is it so? Because UAD is something that has to be considered while determining the book profit. But the brought forward business loss, because it is under chapter number 6, which is in section 72(2), that will not be considered. That will not be considered while determining the book profit. But still there is a catch on this particular context. And what is the catch? The catch is this, that the provision of 72(2) specifically provides a hierarchy of the set-off. And as per the hierarchy, the first set-off has to be done for the brought forward business loss, and thereafter the UAD should follow. But as far as the book profit calculation is concerned, we are only concerned to reduce the UAD. So how do we balance this? This can be given through a numerical, students, over here. Supposingly, your book profit before students, before this UAD and the brought forward loss is, say, rupees 100. Fine, students. Thereafter, you have been given the UAD of, say, rupees 120. There is a brought forward loss of, say, rupees 50. Fine. So how do we go in this context? So students, over here in this scenario, book profit before UAD is 100, and therefore for book profit we only need to reduce UAD. But UAD cannot be reduced unless and until brought forward business loss is been considered. So what we need to do is to notionally adjust the brought forward business loss, and then see how much is the balance of the book profit which is available for UAD. Then we have to see how much is the balance of the book profit which is available for UAD. So if I have to notionally adjust for a time being, the brought forward loss 50 is what I will adjust notionally, and therefore the balance book profit which is available for UAD is 120. The balance book profit which is available for UAD is 120. Sorry, the balance book profit which is available for UAD is only 50. So it is only rupees 50. It is only rupees 50 that will be available for the purpose of set off, as far as the UAD is concerned. So the calculation will go something like this. Herein, the calculation would go something like this: that the book profit 100 before UAD minus UAD. How much UAD can be adjusted? Only 50, because that is the only book profit after the notional adjustment of brought forward business loss. This is the UAD of only 50, students, which is to be considered in this context. And therefore, now you get your balance book profit as rupees 50, and on this balance book profit of rupees 50, you will start calculating the maximum remuneration which is available, and whatever is the maximum remuneration which is available, you will then compare with the actual remuneration, and lower of the two is what will be the amount of deduction in this case. So I hope that all of you are clear with this one now, students. Now the format when you have to do the solution of the total income of the partnership firm, this is how you will deal with the formatting now, students. So the net profit as per the books. Thereafter, below this you see there is a classification of the income. So supposingly in the total income question, if the partnership firm has got, say for example, dividend income or interest on securities, so those will go under the head IFOS. So therefore initially you will remove them from the net profit to be considered separately. And thereafter, students, as I told you, you will focus on doing the adjustment relating to the common provision first, so that at least at that particular point of time you are at ease. So all the normal common provisions which are there, you will do their adjustments, and after doing the adjustment, now you come to 3A. Now in this context, whatever is the remuneration and interest which is paid to the partner as per the books, you need to debit that, add back that. Whatever is the remuneration and the interest which is paid, that would be in the books, that will be added back. And thereafter, students, you are going to reduce what? Reduce the interest which is paid to the partner subject to maximum of 12% per annum. You shall reduce, students, the interest. So if supposingly they have given a lower rate of interest of say 9% to their partners, so that will be the rate of interest that will be reduced. But again, I'm repeating this particular point, that please be mindful of the fact that the interest deduction that you are giving has to be authorized. Okay. After that, students, the UAD adjustment 32.2. I told you that while arriving at the book profit, you will adjust with the UAD. How do you adjust with the UAD? The question already has been given to you above. So that is what would be the adjustment of the UAD. And then that gives you the book profit. And once you get your book profit, thereafter, students, the remuneration which is as per the limit of 40B will be calculated, and then will be compared with the actual remuneration that you have given and debited in the profit and loss account, and that actual remuneration or the limit of 40B, whichever is lower, is the amount of deduction. Okay, once you get this deduction, now your entire book profit and the remuneration interest purpose is served. Now you are in the process of total income computation. So when you are in the process of total income computation, please do ensure to add this 32.2 once again. Why? Because now you have to show properly in computing the total income, you have to show properly about the hierarchy in which the set off has to be done. So above 32.2 that you have reduced was only for the purpose of book profit calculation. But now that the remuneration concern is over, so you are in the process of computation of total income, this hierarchy needs to be shown separately, students, and that is the reason why this brought forward business loss under section 32.2 has to be reduced, and below that the UAD under section 32.2 also will get reduced separately. Good evening, Deepak. So therefore in this particular case, the UAD under section 32.2 also will be reduced separately in this case. Now for this step, student, there is 2 marks. For this step, adding back the UAD as reduced in the book profit calculation, and thereafter reducing the brought forward business loss and the UAD is what is the actual calculation that you have to show, and that gives you 2 marks for it. Other heads of income, then the GTI, chapter 6A, and finally the total income. In the chapter 6A, students, for a partnership firm, these are the very popular deduction of chapter 6A that you may find. That is to say 80JJAA. Other than that, 80G, 80IA. These are the deduction that you are going to find. 80M, obviously it is for the company. 80M, it is for the company, and that is the reason why 80M will not be there at all in this regard. I hope that all of you are clear with this one. So this is all about your partnership form, students. Now you please tell me which is the other area which you want me to take it further. Non-resident taxation, students. Is that what you're looking at right now? Or PGBP? Quickly, students. Dev, Amrita, Naseem, Deepak. Business trust. Let me take first business trust, students, quickly in this context. The surrogate taxes. Ranjit. Fair enough. I will do this sequence then. This sequence is what I am going to do. First of all, for all of you, I will first take the surrogate taxes. Then I will take the NR tax, and then finally the PGBP. So this is a sequence which I am following now. The surrogate taxes, thereafter the NR, and finally the PGBP. So I'll follow this particular sequence and we'll try to complete this one. In between the trust taxation, I will discuss with all of you some important adjustments so that the adjustments are being considered by all of you properly on the trust taxation front. Okay, so I'll do that so that you are being taken care of with the adjustment relating to trust taxation. First of all of you just pay attention very carefully about the surrogate taxes. Students, here, first of all, please understand there is a securitization trust, there is an alternate investment fund category 1 and category 2, and there is a business trust. So always keep these three in your mind because that is how the things will be played upon. So far as the securitization trust is concerned, assessment procedure, Dave, I am doing it tomorrow morning. If you see, that slot is available for tomorrow morning. So tomorrow morning there is a Hindi lecture at 8:30 a.m. followed up by the English lecture at 11 o'clock. So 11 or 11:30, whatever it is. So therefore that assessment procedure, penalties and all, that is for my tomorrow morning session. So that is what I will be dealing with it tomorrow morning. Okay. So now coming back to this particular part, students, all of you pay attention. So securitization trust, whatever is the income which is earned by securitization trust and that has been passed on to whom? To the unit holder. No taxation is there in the hands of the securitization trust. There is a complete pass through, meaning thereby the entire income of the securitization trust will be accessible in the hands of the unit holder in the same manner and to the same extent the way the income would have been assessed in the hands of the securitization trust. So supposingly you will be given a ratio kind of a scenario, and in the ratio, say for example students, there is a case wherein PGBP, business income, long-term capital gains, and say other IFOs. So first and foremost thing, students, in this kind of a question, first and foremost thing, students. Okay, Dave. Thank you. So first and foremost thing, students, you should always understand in this particular context is that, students, please take the ratio first. The proportion in which the securitization trust has earned the income, you need to first take the ratio of it. So you will take the ratio and then they will give you the information about one unit holder who is, say, holding a proportion. Okay. And they have been given a particular amount, say 1 lakh rupees. So 1 lakh rupee needs a split. That 1 lakh rupee, students, will be requiring a split in the same proportion in which the trust has earned the income, and based on that split, accordingly the classification of the income will be done in the appropriate heads of income. Based on that proportion, accordingly the classification of the income will be done in that particular heads of income in the hands of the unit holder. One very important point, students, on this I'll discuss with you at the end of it, but just stay on to this one important point because that is targeted in your RTP question also, which I have done it also in Super 50, but that I'll discuss just a bit later. Second comes is your AIF. So far as AIF is concerned, category 1 and category 2, students, there is a partial pass-through. Partial pass-through would mean that the PGBP income only is accessible in the hands of the business trust, the AIF. Remaining all the income, there is a pass-through concept, meaning thereby it will be accessible in the hands of the unit holder. Now, on this particular point, students, just pay attention that here what happens, there is an important question about the loss. Supposingly there is a loss other than business income. If there is a loss, so whether that loss, will that be allowed to be passed through? So there is two steps you should always keep in mind. Step number 1. The first step is that the loss set off will be done first in the hands of the AIF. So first, students, you will do the loss set off in the hands of the AIF as per the provision of the set off. Whatever is the provision of the set off, like for example, the loss is a long-term capital loss and AIF has got two income. one is the business income and another is the long-term capital loss. So obviously we know that LTCL cannot be set off against the business income. So therefore what will happen in this case? The LTCL cannot be set off, so there will be a pass through. So that is step number 2, pass through, that will happen. But the point that needs to be reconfirmed is that first you will make an attempt to set off the loss at the AIF level, and only when the loss cannot be set off or fully set off, that the portion of the loss would be passed through to the unit holder. Now for pass through also there is a condition, and the condition in this case, students, happens to be that what is the condition for the pass through in this case? You should be aware of that. So the condition for the pass through, students, in this particular case is that for the purpose of the pass through, over here, students, what needs to be considered is this, that here in this scenario the period of holding of the unit holder should be at least for 12 months before the end of the previous year. So they need to hold the security for a period of 12 months. That is the criteria. So if there is any information about a unit holder, say for example your previous year is 21-22 and there is a unit holder, say, who has acquired the unit in the month of 1st of July 2021. So obviously his period of holding is only 9 months. So whatever is the proportion of the loss attributable to this unit holder, that much of the loss will get lapsed. That much of the portion of the loss will get lapsed, and only the balance portion of the loss will be having a pass-through status, and it will be distributed to the unit holder in the same proportion in which they do have their holding in the AIF. I hope that all of you are clear with this one now. Now comes the third case, which is your business trust. The third one is about the business trust. Now, so far as the business trust is concerned, we need to understand which income of the business trust is accessible in their hands and which income there is an assessment in the hands of the unit holder. So the income is that of business trust, but there is again a partial pass through. Some portion of the income of the business trust is assessed in their hands, and their balance portion of the income is having a pass-through status to be assessed in the hands of the unit holder. So here, students, understand one thing: if the business trust has earned any income outside, then that particular income earned by the business trust outside, students, will be accessible in the hands of the trust. At what rate it will be assessed? So the rate is like this, that if there is any special rate applicable on such income which is earned by the business trust, then the special rate of tax will be applicable, like long-term capital gains of 112A, short-term capital gains of 111A. So the respective rate will apply. Apart from that, any other income other than the special income applicable at special rate, if there is any other income, then that is going to be taxed at MMR, which is 30% plus 37% surcharge plus 4% HEC, which comes to roughly around 42 point something. So that is the effective rate of tax on that income. So this is the only income which is accessible in the hands of the business trust. Remaining all the incomes, like the business trust will be earning rental income from the property which they have developed and given on rent. So that is a rental income. Now the rental income, if this would have been assessed in the hands of the trust, it would have been assessed under the head PGBP, because this is the business income. So same would be the status of classification also in the hands of the unit holder. Same would also be the status of assessment in the hands of the unit holder, and that is how the things has to be considered. I hope that all of you are clear with this one now. Okay, now this particular business trust, above that there would be a special purpose vehicle where the business trust would be holding some security, or they would be like a holding company of that particular special purpose vehicle. From that special purpose vehicle they would be earning dividend income, and if they would have given the loan to such SPV, then they would have been earning the interest income. So this dividend income or the interest income would also be accessible in the hands of the unit holder and not in the hands of the business trust. Now there is one catch on the dividend income, students. And what is the catch on the dividend income? The SPV who has earned the dividend income, the SPV who has earned the the SPV who is giving the dividend to the business trust, and that dividend is going to be assessed in the hands of the unit holder. There is one important catch on this particular point, which is that if the SPV has not opted for the concessional tax regime of 115BAA, then that dividend income of SPV given to business trust but accessible in the hands of the unit holder will not be taxable in the hands of the unit holder also. So it is a fully exempt category. It is a fully exempt category. It is neither going to be assessed in the hands of the business trust nor in the hands of the unit holder. I am talking about which dividend income? The dividend income which is earned. The dividend income, students, which is earned by whom? Indeed, the dividend income which is been earned by the business trust from the SPV, that SPV which has not opted for 115BAA provision. But if the SPV has opted for 115BAA provision, students, in that particular case, the dividend income earned by business trust but accessible in the hands of the unit holder will be subject to taxation. I hope that all of you are clear with this one. Now the last point in this surrogate tax is this. Last point, students, and the last point is this, that supposingly the securitization trust or the AIF category 1, category 2, they have, out of their total income, they have distributed only 90%. It will be, we will consider entire 100% for the purpose of the allocation and classification. Entire 100%. So it is irrespective of the distribution that the securitization trust or AIF has done. It is based on what, students? It is completely based on, students, on this particular part of what, students? Indeed, it is completely, students, based on the part of the earning that the trust and the AIF has done. But so far as business trust is concerned, out of 100, if they've distributed only 90, then only 90 is what would get classified finally in the hands of the unit holder. Only 90 is what will be classified finally in the hands of the unit holder. Is that clear to all of you? This is the fundamental difference between the two. Now, students, with that we will start on the NR front. Now let's take one by one, students. Here the first is the residential status. The residential status. Gone are the days when you get the independent question on residential status, students. Now there will not be any independent questions on this. What we have seen in the recent attempts and also in the RTP and the MTPs, that they are merging the concept, this residential status concept, and putting it in your total income question. So that is how you are going to get the question, and that is how we are going to also revise it. Students, starting with this particular part, the foreign company residential status, students, as you all know, it depends upon its poem. So if the poem is in India of the foreign company, then the foreign company is considered to be a resident in India. Whereas if the poem is outside India, students, then the foreign company is considered as a non-resident. Okay, so that is what it is. Now the poem is dependent upon the satisfaction of the active business outside India test. Active business outside India test. Now if the foreign company satisfies the active business outside India test, active business outside India test, then the poem of that foreign company is presumed to be outside India. It is presumed to be outside India. But that is dependent upon if the majority of board of meetings are held outside India. So only when the majority of board meetings are held outside India, that the poem of this foreign company which is satisfying the active business outside India test, the poem of this foreign company would be considered outside India, and hence it is a non-resident. However, in this case also there is one silver lining, which means that this foreign company which satisfies the active business outside India test, whose majority of board meetings are held outside India, it can still be considered as a resident in India if the de facto control of that foreign company is held by one particular person who is a resident in India, or it is an Indian company. The de facto control over that foreign company is by a person who is a resident in India or who is an Indian company. Then in that case the poem of that foreign company will be in India, and accordingly it will make that foreign company as a resident in India. The second part is about the fact that when the foreign company does not satisfy the active business outside India test. If it does not satisfy the active business outside India test, then its poem will depend upon, the location of its poem will depend upon who is that person in that foreign company which is taking the key managerial and the commercial decision for that foreign company, and the second one is where that particular decision is taken. So who takes and where it is taken, based on that two aspect, that the poem of that particular foreign company is decided upon. Okay, now let's talk about the latest RTP question. Now before I do the RTP question, active business outside India test, students, you all are aware. The active business outside India test, what is active business? Active business would mean that the passive income is not more than 50% of the total income. Active business would mean that the passive income should not be more than 50% of the total income. And the passive income comprises of what? Interest, dividend, capital gains, rent from let out of the house property, thereafter royalty and FTS, and also one very peculiar case where both the purchase of the goods as well as the sale of the same goods is from and to the AE. The purchase as well as the sale of the goods is from and to the AE. That particular transaction also would be considered as a part of the passive income, and that also would be considered while determining whether it crosses the threshold of 50% or not. And if it does not cross the 50%, then we will say that the business of the foreign company is active. For outside India test, students, there are three different parameters that has to be considered separately. First is the parameter relating to the asset of the foreign company. The asset, the presence of their asset in India should be less than 50%. Second parameter is the number of employees in India also should be less than 50% vis-a-vis the total employee of that foreign company. And the third one happens to be the payroll. When you talk about the payroll, students, you will have to then take up the average. When you talk about the payroll, students, you will then have to consider the average. Forget the average, the payroll which you have paid, the payroll, students, that you have paid to these particular Indian employees, that also should be less than 50% of the total payroll that the foreign company is paying to all its employees. So that way only we will say that the active business outside India test is being fulfilled. Now coming to the RTP question, students, there was one RTP question where they have told you to compute the total income of the foreign company. The total income of the foreign company. And in the total income question of the foreign company, students, they have given you the data of all the passive income only. There was no information about the business income. So obviously when there is no information about the business income and all the data only is relating to the passive income, so it is safe to assume in your notes that the passive income is more than 50% of the total income of that foreign company. And if the passive income is more than 50% of total income of the foreign company, therefore the active business outside India test is not fulfilled. And if the active business outside India test is not fulfilled, students, in that particular case, what is that we are going to say? if the active business outside India test is not fulfilled, then we have to determine who is that person who takes the key managerial or commercial decision for that foreign company, and the second one is where that decision has been taken. So who takes the decision and where that decision is taken, that becomes the final basis of the conclusion about the location of the poem of that foreign company. Now, interesting data was given in this RTP question, where they have given to you that the shareholders of the foreign company met in India, and the meeting that they did in India was for the purpose of their some shareholding right and some acquisition relating to some asset was concerned. So tell me one thing, whether this meeting, does it anyway provides you that level of understanding about who is the person who is taking the key managerial and commercial decision of that foreign company? No, because the meeting which was held in India was for the purpose of, it was a shareholders meeting for the purpose of the shareholders right and for the asset disposal. So therefore, in that case, we could assume, we have to assume based on the data given to us, that it is safely assumed that the information provided in the question is not sufficient to decide who is the person who is taking the key managerial and commercial decision of that foreign company, and therefore it is assumed that the foreign company's poem is outside India. This is how you have to write your answers. So it is assumed that the foreign company's poem is where? Outside India, students. Is that clear to all of you? And if it is outside India, the foreign company is a non-resident. And if it is a non-resident, students, only the two categories of income of the non-resident, only the two categories of the income of the non-resident is deemed to accrue as in India. It is assessable in India. Which are those two categories? Income which is deemed to accrue as in India. The second one is the income which is received in India. Is that point clear to all of you, students? Fine. By the way, one last point before I go through the next residential status of individual. Students, when you talk about the asset test, which should be less than 50% of the total asset of the foreign company, on that asset test, you have to be very careful. If the asset is a depreciable asset, then you have to take the average of both the opening as well as the closing balance. You have to take up the average of both the opening as well as the closing balance. So this is the average that you all will have to take into account. I hope that this point is well taken by all of you. Fine, so this is one thing that you should keep in mind. Now coming to the second particular part, students, is for the residential status of the individual. Now again, if you see the RTPs or the MTPs, independent questions are not asked. They do use your case study based question for using some part to test you on the residential status of this particular SSE. Now let's look upon to this one by one. Individual, students, all we know, there are two basic tests out of which one has to be satisfied. Now in that, the first one happens to be the minimum stay in India should be at least 182 days in the previous year. That will make the individual the resident. If not, then the second basic test says that if the minimum day of stay in India is 60 days in the current previous year, and in the last 4 preceding previous year the aggregate number of stay is minimum 365, then also this particular person could become a resident in India. Now the second basic condition of 60 days and 365 days is not applicable. It is, students, not applicable in the case of students, point number one, a citizen of India who is leaving India for the purpose of taking up the employment outside India. That is the first point. And the second one is the citizen of India or a person of Indian origin. In the second point, we have to also consider the person of Indian origin. So a citizen of India or a person of Indian origin who is coming in India for visit purpose. For visit purpose, even in this particular case, only the first basic condition of minimum 182 days is what needs to be looked upon. Now let's come to the amendment of the Finance Act 2020. As per the amendment of the Finance Act 2020, students, what they have said is that if a Indian citizen or a person of Indian origin, if they are coming in India for visit purpose, then apart from the first basic test of 182 days, apart from the first basic test of 182 days, there is second basic test also that needs to be considered. There is a second basic test also that needs to be considered, and that second basic test is that 120 days minimum stay in the current previous year and in the last four preceding previous year, or last four preceding previous year, the minimum stay of 365 days. Now this second basic condition, students, of 120 days in the current previous year, in the last four preceding previous year, minimum 365 days, this would be applicable only if such individual, which individual? Citizen of India or a person of Indian origin who is coming in India for visit purpose, if such individual is having the total income excluding the income from foreign sources of more than rupees 15 lakhs. So if his total income excluding the income from foreign sources is more than rupees 15 lakhs, then in that case the second basic condition also would be seen for such individual, and if he satisfies one of the two basic condition, then such individual will become a resident. Now be careful, if because of this second basic condition as per the Amendment of Finance Act 2020, if that individual becomes a resident in India, then his status, students, his status would be R and NOR. Directly, students, his status would be R and NOR. What is the advantage of the status of having R and NOR? The advantage is that the foreign income, that is the income which is accrued outside India, also received outside India, will not be chargeable to tax under the Act. Accrued outside India and received outside India will not be chargeable to tax under the Act, except for one income, which is if there is a business which is conducted outside India. There is a business which is conducted outside India, but it is controlled from India, students. But it is controlled from India, then that particular business income, students, that particular business income will be charged to tax under the Act. I hope that this particular point is well taken by all of you. Now the second amendment, students, which you all can see is this one, 618. This particular amendment of 618, students, again it's a very critical particular point. This particular amendment of 618, students, is also very critical point. Now students, this 618, this is actually will make the individual as a deemed resident. This will make that individual as a deemed resident. Now please be careful that 618 should be considered only if 61 is not satisfied. So if in the question you find that the 61 conditions of the two basic conditions are not fulfilled, in that particular case you can check for the applicability of 618. Now 618 is applicable to Indian citizen. That Indian citizen whose total income other than the income from foreign sources exceed rupees 15 lakhs. And third condition is equally very important. The third condition is that this particular individual who is having a foreign income outside India, his foreign income should not be liable to tax in India. His foreign income should not be liable to tax in the foreign country. So if all these conditions are satisfied, all the three conditions, which are the three conditions? Citizen of India, so it is not for the PIO, it is only for the citizen of India, having the total income excluding the foreign income of more than rupees 15 lakhs. And the third is the foreign income is not liable to tax in the foreign country. If all the three conditions are satisfied, then this individual would be deemed to be a resident in India. Now students, let's come to the Amendment of Finance Act 2021. Now what has happened is that supposingly the foreign income is exempt in the foreign country as per their local laws, and because of which this particular individual is not liable, because of this his tax liability is nil in the foreign country. So question to all of you is whether this individual is he liable to tax in the foreign country? Because if he is liable to tax in the foreign country, then this 61A will not apply. And if 61A will not apply, then the deemed resident as per 61A will fail, which implies that he will be considered as a non-resident. So whether this particular example which I gave it to all of you about the foreign income getting exempt in the foreign country as per their local laws, thereby the tax liability has become nil in the foreign country, is he liable to tax or not? To that, students, the answer is he is indeed. He is, students, indeed liable to tax in the foreign country, but because of the exemption, his tax liability is nil, which means that he is liable to tax, but he is not liable to pay the tax. He is liable to tax, but he is not liable to pay the tax. But for the purpose of deemed residents of section 61A, what we need to see is that he is not liable to tax. So if he is liable to tax, then 61A is not applicable, even though he is not liable to pay the tax. But the fact that he is liable to tax, 61A is not applicable, and therefore he will become a non-resident. But if this condition is fulfilled and he is not liable to tax in the foreign country, then as per 61A, it will be a deemed resident again. And be careful, students, if you are a deemed resident, ultimately your status will be R and NOR. Your status, students, will be R and NOR. I hope that all of you are clear with this one. So this is all about your residential status, students. That has been there. Now coming to our next one, which is section 9. After residential status, students, section 9. Now in section 9, if you all will see, students, directly you will be getting into section, the first one, 911, which has got business connection and indirect transfer as one of the most important area for your examination. For the business connection, students, keep this thing in mind. Business connection, there are two important concepts that you should know, which could be targeted in the examination. The presence of the agent giving rise to the business connection, that is point number 1. The presence of the agent in India giving rise to business connection, that is point number 1. And the second one, students, which also could give rise to a business connection to that non-resident in India, that is because of the significant economic presence, SEP. So let's look upon one by one this two aspect of business connection. The first one happens to be the presence of the agent in India giving rise to business connection to that non-resident. Now students, this agent which we are talking about it should either wholly or mainly perform any one of the following three activities. This agent in India either wholly or mainly should perform one of the following three activities in India. And what is that activity? Point number 1. That agent, students, should habitually this agent should play a principal role which should lead to the conclusion of the contract. Now here, students, actual conclusion of the contract has got no relevance. What has to be seen is that whether this particular agent has played a principal role because of which the contracts are getting concluded. If the answer is yes, then indeed the non-resident will be said to have a business connection in India, even if that agent has not actually concluded the contracts. But did he play the principal role which led to the conclusion of the contract? If the answer is yes, then we will say that there is a case for a business connection for that non-resident in India. The second particular point, students, is about he is habitually maintaining the stock of goods and delivering the goods on behalf of the non-resident. So first of all, let me tell you that each of the activity of the agent is independent to each other, and that independent activity, if fulfilled, that will give rise to the business connection to that non-resident in India. Now the second one, students, the activity is very limited, and this limited activity is for the purpose of maintaining the stock of goods, students, and thereafter delivering these goods, students, on behalf of the non-resident. So one, you need to maintain the stock of goods, and then thereafter you need to deliver that goods to on behalf of the non-resident. So if this is the only activity that you are performing, students, then indeed we will say that this particular non-resident will have a business connection in India. Now, this is an important one, students. If supposedly, students, a non-resident is having an agent who is independently buying and selling the goods of various non-residents in India, and that independent activity he is undertaking in the ordinary course of his business, then presence of such agent will not give rise to a business connection in India to the non-resident. Now here, what is the emphasis to be given upon? Students, be very careful on this one. Here, students, the emphasis is that in this case, that the agent which we are talking about it is not mainly or wholly performing the activity on behalf of the non-resident. He is not mainly or wholly performing the activity on behalf of the non-resident. So here what he is doing is just independently buying and selling the goods of all the non-resident, and thereafter proceeding it to the buyers in India. If that is what he does, then in that scenario, students, this agent presence will not give rise to a business connection in India. So this is the first particular category, and now come to the second category. Second category of the business connection is the concept of the significant economic presence. Now students, in the case of a significant economic presence, if a non-resident does not have any physical presence in India, but that non-resident, students, is independently selling the goods or providing the services to any person in India in excess of rupees 2 crores in the financial year, that is aggregate 2 crores with all the persons in India during the financial year 21-22, if he has sold the goods to the persons in India or provided the services to any persons in India in aggregate of more than rupees 2 crores, then we can say that the non-resident has a significant economic presence, and because of which the non-resident will set to have a business connection in India. The second particular point, students, is about what? The second particular point, students, is about that the non-resident has user base in India of minimum 3 lakhs. User base, a classic example would be like an app download category, Netflix. Now there is user who download the app, and therefore if you have only user base of at least 3 lakhs or above with whom you are in a position to interact frequently, then in that particular case also we will say that having the user base of at least 3 lakhs or above in the previous year will also give rise to a significant economic presence to the non-resident in India, and accordingly will give rise to a business connection in India. Accordingly, students, will also give rise to a business connection in India. So this is the case. Now the next one, students, in section 911, students, is about the indirect transfer. The indirect transfer, students. Now indirect transfer, let's try to understand this one in a practical manner. In this context, students, what will be the case? Obviously, the practical question only would be targeted in the exam on the indirect transfer. So how the target will be done, students, let's focus upon on that particular part. So over here, if you see, students, in the case of an indirect transfer, what happens? Herein, there would be a Indian, there would be like, they would be giving you Indian company, and then there would be an ultimate non-resident who is doing this level of structuring. So Indian company, and then there is also a non-resident who is there the other side, and then what this non-resident does, he is floating a foreign company in between, and through that foreign company it is making the investments in India. Okay, so this is the kind of a structure in the question that you're going to find it in the examination. Now, before we proceed further, let's try to understand the basic provision. As per section 911, any income of the non-resident is deemed to accrue or rise in India if the income is because of the transfer of the capital asset which is situated in India. So if the income is because of the transfer of the capital asset situated in India, we will say that yes, the income arising on such transfer is deemed to accrue rise in India. Now here, this non-resident will say that I am selling. This non-resident will say what? That I am selling the shares of the foreign company, and because that I am selling the shares of the foreign company, primarily therefore no capital gains accrues in India. But now comes this amended provision of section 911, as per which if the foreign company, which foreign company? The foreign company whose shares was transferred by this non-resident. If this foreign company derive its own value substantially from the Indian asset, if this foreign company derive its own value substantially from the Indian asset, then the shares of such foreign company is deemed to be situated in India. And if it is deemed to be situated in India, students, accordingly the capital gains will be calculated. In this case, sorry, if it is deemed to be situated in India, accordingly the non-resident who has transferred the shares of such foreign company will give rise will have what, students? Will have the capital gains income which is also deemed to accrue rise in India. Now will have a capital gains income which is also deemed to accrue rise in India, isn't it? So now we need to find how this foreign company whose shares was transferred by the non-resident, how this foreign company derive its own value substantially from the Indian asset. So for this, we need to see the substantial test. Now substantial test, students, you should be very careful. There are two aspects to this. The two aspect is, point number one, when do we test this substantial condition? On which date we need to test the substantial condition on this foreign company to decide whether it is getting its own value substantially from the Indian asset or not. And the second particular point, students, is what is that substantial test? So I will be discussing the second particular part because in the examination they will focus on the second particular part. So as per the second part, if the foreign company, which foreign company? The foreign company whose shares was transferred by the non-resident. So if the foreign company is holding the investment in the Indian asset, does its fair market value is more than rupees 10 crores? So this is the first particular condition that we need to see, whether the fair market value of this particular foreign company, is it more than rupees 10 crore or not? That is the first condition. And the second condition that we need to see over here is that whether the fair market value of this foreign company, is it at least 50%? Is it at least the fair market value of the Indian investment? The fair market value of the Indian investment held by this foreign company, is it at least 50% of the total fair market value of all the asset of the foreign company? Okay, so if both the condition, which condition? The 10 crore condition as well as the other condition of 50%, if both the conditions are satisfied, then we will say that this foreign company derive its own value substantially from the Indian asset, and therefore the shares of this particular foreign company is deemed to be situated in India. And if it is deemed to be situated in India, then that non-resident who has transferred the shares of this foreign company will get a capital gains which is also deemed to accrue rise in India. Now in one particular case, this non-resident will not have the capital gains. This non-resident will not have a capital gains taxable in India, even if the foreign company whose shares was transferred by this non-resident, this foreign company derives its value substantially from the Indian asset. So which is that particular case? That particular case is when the non-resident is having a minority interest in this particular foreign company, which means that he does not hold more than 5% of the voting power at any point of time during the previous year. So if it does not hold more than 5% of the voting power at any point of time during the previous year, we will say that being a minority shareholder, this provision of indirect transfer will not apply to such non-resident transferor, and hence no capital gains will be taxable in India. The last point, students, is about the calculation of the capital gains. Please understand one thing over here. When we have to calculate the capital gain, students, over here there is a long-term capital asset. The non-resident has transferred the long-term capital asset. Which is a long-term capital asset? The shares of the foreign company, which is deemed to be situated in India. Deemed to be situated in India. Now, so far as India is concerned, because it is a foreign company, for India it is an unlisted shares, not listed in any of the stock exchange in India. Okay, now if that is the case, how an unlisted shares will become a long-term capital asset? If the period of holding of the shares is more than 24 months. Okay, now if this is the case, then as per 112, the long-term capital gain, students, will be calculated without providing the indexation benefit, and the rate of tax would be 10%. Long-term capital gains will be calculated without providing the indexation benefit, and the rate of tax, students, would be how much? Would be 10%. So this is how, students, it will be referred in this particular context. This is how, students, it will be referred in this particular context. I hope that all of you are clear with this one. Every one of you. So this is how, students, this is going to be considered over here. Now the last particular point is the fair market value concept, students. Very important concept, because although it has not been targeted, but still we will try to understand this FMB concept once. Students, as I told you that the fair market value of the Indian investment should be more than 10 crores. And the second one is that the fair market value of the Indian investment should be at least 50% of the total fair market value of all the assets. So the question is about the fair market value. Now let's have a look to this particular scenario which has been developed here in this particular slide. So supposingly there is the non-resident is in USA. It has made the investment in India through the Singapore company. So this Singapore company is a foreign company whose shares subsequently will be transferred by the non-resident. Now this Singapore company has acquired a stake in the Indian company of 20%. This Singapore company has acquired a stake in that Indian company of 20%. Okay, now what they will give you further data, that the fair market value of this Indian company, they are giving you fair market value is 180 crores. Now this 180 crores is after reducing a corresponding liability of 20 crores. This fair market value of the Indian company is 180 crores after reducing the corresponding liability of 20 crores. So now, students, when you have to determine the fair market value for this indirect transfer provision, whatever is the corresponding liability that has been reduced, that needs to be added back. Whatever is the corresponding liability that has been reduced, that needs to be added back, and therefore now my fair market value has become 200 crores. and how much stake that the Singapore company is having in that Indian company, 20%. So 20% of 200 crores gives you 40 crores. So is the fair market value of the investment in the Indian company, is it more than rupees 10 crores? Answer is yes. The fair market value of the investment in the Indian company is more than rupees 10 crores. So the first substantial condition is satisfied. Let's try to stretch this particular uh, question further. Supposingly the fair market value of all the asset of this foreign company, that Singapore company, is 50 crores. The fair market value of all the assets of the Singapore company is how much? 50 crores. So see the proportion over here now. All of you, if you see the proportion over here, so out of 50 crores, 40 crores is from, out of 50 crores students, 40 crores is from the Indian investment. So is the percentage of the fair market value of the Indian investment, is it at least or more than 50% of the total fair market value of all the asset of the foreign company? Answer is yes. So both the substantial condition is satisfied, and therefore we can conclude that the shares of the Singapore company derive its own value substantially from the Indian asset, and therefore its shares is deemed to be situated in India, in which case the non-resident transferor will be subject to capital gains on the transfer of the shares of such Singapore company shares. So I hope that all of you are clear with this one now. Coming on to this particular part, the next one in section 911 is about the salary income. So when the salary income of a non-resident is deemed to accrue as in India, so the salary income of a non-resident is deemed to accrue as in India if the services are rendered in India. So if the services are rendered in India, then whatever is the salary in respect of such services will be deemed to accrue as in India. Apart from this, there is one typical case where supposingly there is a paid leave period which is either immediately following the services in India or it is immediately before the services in India. If supposingly for any month there is a paid leave, so whatever is the salary which has been given for that particular period as well, the salary income will be deemed to accrue as in India. The salary income, students, for that particular period also would be deemed to accrue as in India. Fine. Now there is a very important judgment of the Supreme Court in Eli Lilly's case, which has been frequently targeted and also covered in your RTP as well. In Eli Lilly's case, students, what has happened in this regard is this, that there is a case of a employee of the foreign company who have been deputed for some of the work with Indian client, and as per the agreement the Indian client were supposed to give some allowance to the employee of the foreign company. On that allowance they will ask you the question that whether the Indian company, are they liable to deduct TDS on such allowance paid to the employees of the foreign company, and that too TDS under section 192. Whether they are liable to deduct TDS under section 192 on this allowance which the client has paid to the employees of the foreign company, are they liable? To that, students, the answer is yes. In section 192, students, very carefully, yes Disha, it is in TDS chapter also. In section 192, students, they have used the word any person will be responsible to deduct TDS if they have paid, what, students? If they have paid us a particular amount which is chargeable in the hands of the recipient under the head salary, So we have to focus on the employee, whether the employee who are receiving this allowance in their hands, whether it is chargeable in the hands salary. To that the answer is yes. Why? Because this amount that they are receiving in consequence of their employment with the foreign company. They are not getting it independently, but in consequence of their employment with the foreign company, and hence the amount is chargeable in their hands under their salary. And if it is chargeable in their hands under their salary, then any person who is making the payment of such amount will be required to deduct TDS under section 192. Now the question that they have asked in that particular RTP is that what is the tax implication? So the first tax implication, students, you will have to write in your answer about the applicability of section 192 and conclude by saying that yes, it is applicable. And thereafter, because the Indian client has not deducted the TDS, thereafter there are some other consequence also that will be felt. And what is the other consequence? The Indian client who hasn't deducted the TDS will be considered as an assessee in default. And because he is an assessee in default, the first thing, what are the consequences? Point number one, the TDS amount would be recovered from this particular defaulter. Second one would be the penalty. The penalty, students, that would be levied would be equivalent to the default that has been made. And the third one, students, is the interest that will be charged at the rate of 1% per month or part thereof. So this would be the interest, students, that will be there in this regard. So this is the consequence that you have to put across in this particular context. Now the next is your dividend income of the non-resident over here. Now so far as the dividend income is concerned, the dividend which has been paid by an Indian company, so a non-resident, students, or a foreign company which has made the investment in an Indian company, and out of that Indian company they are in receipt of a dividend amount, then that dividend amount is always deemed to accrue rise in India. I hope that every one of you are clear with this one also. Now coming to this very important particular part of the discussion, interest, royalty and FTS. Now students, I should tell you one thing. On the royalty part, there is a Supreme Court judgment which is also covered in the RTP, for which I already have touched upon that Supreme Court judgment earlier also. In my Super 50 session also it was been there. My humble suggestion to all of you is that please do that particular judgment carefully for your examination. That Supreme Court judgment, students, is most likely and most expected for your examination. I have done this one also. I will also put up the link if you want after the lecture gets over in my Telegram channel, so that you can see therein itself and find it out and accordingly go through it once. So now coming on this particular income, interest, royalty and the FTS income. Students, first there are two things only now to be discussed. One is when these income will be accrued in India, and at what rate, how the assessment of this income will be made in India. So the first one is when this income will be deemed to accrue rise in India, and the second one is how the assessment of these income will be done in India. So let's talk about the accrual part. So accrual, so first of all, this income, which income? Interest, royalty and FTS. Whose income? Non-resident income. So it means who is the payee or the recipient? It is the non-resident. Check who is the payer now. Check who is the payer. If the payer of the amount, students, if the payer of the amount happens to be a government of India, then always these income would be deemed to accrue rise in India in the hands of the non-resident. But if the payer of that particular amount, students, if the payer of that particular amount happens to be whom? Happens to be a resident, or even a non-resident can also be a payer. If the payer of the amount happens to be a resident or non-resident, then check if the payment of interest or royalty or FTS, is it being made in respect of their business or their source in India or outside India. Because if it isn't made in respect of a business or a source outside India, students, then no income of such non-resident will be said to have accrued in India. No such income, which income? Interest, royalty and FTS income will be said to have accrued in India. But if the payment is in respect of their business or their source which is situated in India, then yes, this interest, royalty and FTS received by the non-resident payee will be deemed to accrue as in India. Now, if it is deemed to accrue as in India, students, you have to be very careful. If it is deemed to accrue as in India, then the following 2 points will become irrelevant. The following 2 points will become irrelevant to be considered in our discussion, and that is number 1, whether the non-resident has any place of business or a business connection or any other physical presence in India. This point becomes irrelevant now. Second point is whether the non-resident has actually performed or provided the services in India. Even this particular point will become irrelevant. So this as well as this, both the points becomes irrelevant once we have concluded that the interest, royalty and FTS income of such non-resident is deemed to accrue as in India. And how we have concluded that? Based upon who was the payer, and if the payer is resident and non-resident, the payment, was it in respect of the was it in respect of the business or a source in India or outside India? I hope that all of you are clear with this point now. Every one of you. Now, why I'm making so much of emphasis? Because there is one question that you may be aware in the RTP and the past year question, where they will tell you that there is a particular non-resident who is providing a technical service 50% of the to an Indian client. 50% of the service that non-resident has provided, 50% of the services, students, that non-resident has provided primarily by coming in India, means provided in India when he was physically present in India, and 50% of the services he provided to this Indian client from his own location. So in such particular case, students, we will say that the salary income, the FTS income, 100% of the FTS income will be deemed to accrue as in India. 100% of the FTS income, students, will be deemed to accrue as in India, will be our conclusion in this particular case. Is that clear to all of you? So that's what I told you. Once you have concluded that the income is deemed to accrue as in India, then it is irrelevant now to consider further whether the non-resident has got a business connection or a place of business or any physical presence in India, or whether or not the non-resident has provided the services in India. These becomes irrelevant criteria completely. So that is the point, students. And after this, students, the second one is about the assessment. On the assessment front, students, I will first take across the assessment of the interest, this one, and then interest income, and thereafter I will do the assessment of the royalty and FTS income. Coming to the assessment of, students, please have a look to this one. If you see over here, the dividend part, dividend, students, always is taxed at 20%. The dividend income earned by a non-resident or a foreign company is always taxed at the rate of 20%. However, I must tell to all of you that, students, just now I told you about the business trust. Now there are two cases where the dividend income of a non-resident is taxed at the rate of 10%. Two cases are there, students. Now, which are those two cases where the dividend income is taxed at the rate of 10%? Point number 1 is when the business trust has given the dividend. The business trust, students, has given the dividend. Now, which dividend? That dividend which the business trust has received from the SPV, and the SPV has taken the concessional rate of 115BAA. So if the SPV has taken the concessional rate of 115BAA, then the dividend that it has given to the trust, which is going to be accessible in the hands of the unit holder, students, it will be taxed at the rate of 10%. When it will be taxed at the rate of 10%? When the unit holder is a non-resident. But if the SPV has not opted for 115BAA, and has paid the tax as per the normal provision, and thereafter it has given the dividend to the business trust, then the trust passing on the dividend to the unit holder, in their hands it is exempt. So this is how it goes with it. The 10% tax in the hands of the non-resident being the unit holder of the business trust receiving the dividend from the SPV, that SPV which has opted for 115 BAA. So that point of time, the unit holder in whose hands this dividend from SPV will be taxable, this is dividend from the SPV which is going to be taxable in the hands of the unit holder being a non-resident, the tax rate would be at 10%. The tax rate would be at 10%. The second case where the dividend is taxed at the rate of 10% is the case where the dividend is received from ADR and GDR. So when the dividend has been received by the non-resident from the GDR, then even that dividend income is taxed at the rate of 10%. Okay, now let's come to the interest income of the non-resident. Now you can see over here the interest income of the non-resident. There are three rates I've given you. The third rate, by the way, it is a normal rate. So there is no special rate, but the first two is a special rate. The third rate, any case, is the normal rate, but the first two happens to be the special rate. Let's focus on this particular part of it. 5% of the special rate of tax is applicable if the non-resident has earned the interest income out of the investment from business trust, or second, investment in long-term infrastructure bonds, and the third one is the rupee denominated bond investment in rupee denominated bond. So the interest income in these three cases will be assessed in the hands of the non-resident at the rate of 5%. Students. ICI, in one of the question, they have given that there is a capital index bond. Students. If it is a capital index bond, students, you tell me. If it is a capital index bond, students, then you tell me whether the capital index bond or investment in capital index bond, if they have made the investment and from which they are getting the interest income, will this be charged at the rate of 5%? Answer is no. I only told you about the three particular eligible investment in which capital index bond is not there, and hence capital index bond will not be taxed at 5%. It will be then taxed at 20% or 40% as the case may be. Now 20% is the case for all the remaining investment made by the non-resident by providing a foreign currency loan. So this interest income the non-resident is getting by providing a foreign currency loan, students. Foreign currency loan. So if a foreign currency loan has been given to the Indian companies or any Indian entities from which the interest income is earned by the non-resident, then only 20% rate would be applicable. This again is a flat rate. The special rate means the flat rate. In one of the question as recent as in this RTP, they have given you that the non-resident has provided a technical service to the Indian client. The non-resident has provided the technical services to the Indian client, and the Indian client has given the consideration towards such technical service out of issuing its own debentures. Now the question therefore comes in this regard is that, first of all, the technical service consideration is given in the form of debenture. Now that debenture will subsequently fetch interest. Now whether that interest will it be charged to the special rate of 20%? To that the answer is no, because this interest income is not out of a foreign currency loan. It is a loan which is created by the Indian company by issuing its own debenture, and that debenture is issued in INR. So therefore in that particular case, this interest income will not be subject to 20% tax, but will be subject to the normal rate of tax of 40%. 40%, which is the normal rate as applicable to a foreign company, that is the rate of tax that is going to be made applicable. I hope that all of you are clear with this one. So this is all about the assessment of dividend and interest income of the non-resident. And now then we come to, students, this particular part. The assessment of royalty and the FTS. Now so far as the assessment of the royalty and FTS is concerned, now there are two sections which governs the assessment of the royalty and FTS. One happens to be 44DA and another happens to be 115A. 44DA, if it falls under 44DA, then the assessment will be made on net basis, whereas if it falls under 115A, then the assessment will be made on gross basis. So one is net basis assessment, another is gross basis assessment. So under what circumstances the assessment of the royalty and FTS income of a non-resident will be undertaken under section 44DA? For that, again, two conditions is required to be satisfied. The first condition happens to be the non-resident, students. The non-resident over here is having a permanent establishment in India. The first condition is the non-resident is having a permanent establishment in India, and through this permanent establishment, the non-resident is providing the services. In fact, in some of the questions which is given to you by the ICAI, they are telling you that the non-resident has got a permanent establishment in India, but the non-resident in some cases is providing the services bypassing the P in India. Bypassing the P in India, meaning thereby without involving the PE in India, it is providing the services directly to the Indian client, in which case the assessment of this royalty and FTS income will be under section 115A and not under section 44DA. This is how it has to be considered. Okay, so this is precisely how it has to be looked upon. Now, if it is 115A, the rate of tax is at 10% on gross basis, no reduction of any expenditure. But whereas if it is under 44DA, students, then net basis assessment is going to be undertaken. Two important points. One is about the maintenance of the books of accounts. It's mandatory if the assessment is under 44DA, plus irrespective of the turnover, the audit also becomes compulsory. Audit also becomes compulsory in this case. Now there is a corresponding deduction of the expenditure that has to be given in this regard, and the deduction would be here. The deduction is restricted only in respect of the P in India. Only in respect of the P in India. So therefore there is a couple of very popular adjustment which tells you that the reimbursement is done by the Indian P to the foreign HO. By the Indian P to the foreign HO. And further they will also tell you that this reimbursement is done in respect of its own expenditure, which is met by the foreign HO, and therefore the reimbursement is done by the Indian P. So this expenditure will be allowed as deduction, but if the reimbursement done by the Indian P is in respect of its share in the HO expenditure, then such reimbursement will not be allowed as deduction. Okay, now students, there is two important procedures that has to be considered by all of you. First is about the fact that exemption available to file the ROI. Does the non-resident are they exempt in filing the ROI? There are three cases, students, where they are exempt to file the ROI. Which are those three cases? The first one is when the non-resident is having only dividend income, interest income, royalty and FTS income. So it is only these income which the NR has. Second condition is when these income which the NR has is accessible under section 115A, meaning thereby, like in case of royalty and FTS, it could have been assessed under 44DA, but they have said that in order to get the exemption to file the ROI, these income, which is the only income of the non-resident, these income should be assessed under section 115A. And the last point is that the TDS, the payer, which is making the payment of these income to the non-resident, which income? Dividend, interest, royalty and FTS. So these income for which the payer is making the payment, the TDS should be deducted by the payer as per the Act rate. As per which rate? The Act rate, and not as per the treaty rate. So if the treaty rate is what is looked upon by the payer, and that is the rate of the TDS, then the exemption to file the ROI will not be available to the non-resident. That is the first point that you should always keep in mind. Now there is one more particular place where the exemption is given to the non-resident, and that is in respect of the foreign sports person who has got only the three incomes. Which are those three incomes? I think all of you are aware of that. So the three incomes in that particular case happens to be the earning by participating the matches in India, contribution in the articles in newspaper, in the sports magazine, and the third one is the advertisement. So if they have got only this three income and no other income, and the TDS has been deducted as per the Act rate and not as per the treaty rate, then in that particular case also the non-resident sports person is exempt to file the return of income. And the last category, students, is the NRI. In the case of NRI, which is opting for Chapter 12A, Chapter 12A students, there also the same particular concept is applicable, which is that the NRI opting for Chapter 12A, exemption to file the ROI is available to such NRI if they have got only that income which is specified in Chapter 12A and no other income, and the TDS is deducted at the applicable rate which is under the Act, not as per the treaty. So if these conditions, students, are satisfied, then again the exemption is available to the NRI towards the filing of the return of income. The exemption is available to the NRI towards the filing of the return of income. So these are the three cases of the exemption, students. Now be careful, one more important procedure, students, which is there. Students, whenever the payee or the recipient of the income is a non-resident and the TDS has to be deducted as per the Act rate, so be careful, the TDS has to be deducted as per the Act rate, then whatever is the Act rate, you need to by default load the HEC of 4%. So that loading of 4% has to be done mandatorily in this case. I think all of you are aware of that. Now there are a couple of this RTP questions which has been there over here. Please have a look. In one of the question runs, they have said that the non-resident has got a dividend income, and this dividend income is received. And that is of rupees 79,000. In second case, they are talking about royalty which is earned or which is payable or which is accrued, which is of rupees 1 lakh. If the term that has been used as received, so please put a footnote in the answer saying that since it is received, so obviously it will be received net of TDS. Now net of TDS calculation, so you need to gross it up in the computation of total income. And how do you gross it up? Supposingly the gross is 100, then the TDS element, students, is 20.8. Considering it is a dividend is 20% to 20.8. So the net amount is 79.2. This 79.2 corresponds to 79,000. Then how much is for 100? That is what will be your gross income. Is that clear to all of you, students? Fine. So this is all about this particular point. Now students, the remaining, the next particular part, students, you will be dealing, and this is, as you all know, the simple one, students, which is a category herein. I'll just tell you, students, herein non-resident sports person, taxation of non-resident sports person at 20% that we have discussed. The other one is double taxation relief. In the case of double taxation relief, students, my suggestion to all of you is that please directly go to the practical questions. Practical question. And in Super 50, students, if it is possible for you, in Super 50 there is an MFN concept which has been there. So practical questions, only selected practical questions you will see from the double taxation relief, which also involves foreign tax credit. So therefore that is directly a question to be referred, and this thereafter the MFN status from the Super 50, and finally students thereafter you have the NRI chapter 12A. Again, if possible, directly a practical question will be sufficient, one practical on that. And the last one, students, is the FI. FI I'll discuss with you just now straight away, students. So FI I am discussing with you straight away. NRI, by the way, I should tell you that so far as the NRI is concerned, in the case of the NRI who is opting for chapter 12A, there students you will find that the rate LTCG which they have got out of the specified asset, the LTCG students that they have got out of the specified asset, that LTCG will be taxed at the rate of 10% without any indexation benefit. Without any indexation benefit. Okay. However, this LTCG which you will compute, they will be eligible for conversion and reconversion of the income in foreign currency, meaning thereby when you calculate the long-term capital gains, then there is a full value of consideration, then there is less expenses on transfer, then there is a cost of acquisition, isn't it? So each element will require the conversion into a foreign currency first by applying the average of TT buying rate and the selling rate. Now if it is a full value of consideration, the average would be that as on the date of transfer. Next is your expenses on the transfer. In the case of the expenses on transfer also, whatever is the amount in the INR, you will convert into foreign currency, and the same average of the TT buying and the selling rate will be considered as on the date of transfer. For the cost of acquisition, students, the average that is there for the TT buying and the selling rate, this average you will take as on the date of purchase. So you will convert each element into foreign currency and finally calculate the capital gains in foreign currency, and that capital gains converted, that capital gains which you have calculated in foreign currency will be reconverted into INR, and for the purpose of reconversion, students, for the purpose of reconversion, you will multiply it with the TT buying rate. You will multiply it with the TT buying rate as on the date of transfer, and that way you will get the long-term capital gains in the INR. Unfortunately, this conversion and reconversion concept, first of all, I should tell you this conversion and reconversion is only applicable in the case of chapter 12A. No other places you will find this concept of conversion or reconversion to be undertaken. Only for chapter 12A calculation, this conversion reconversion happens. Other than that, there is no other places that the conversion and reconversion happens. So whatever is the long-term capital gains that you have calculated by doing this particular technique in chapter 12A, this long-term capital gains will be taxed at the rate of 10%. That is what chapter 12A says. However, in the examination question, students, you may not find at all this conversion and reconversion data. So simply you can say that fine, we will just stick with whatever we have and we'll calculate the long-term capital gains, and that is what it is. Be mindful of the fact that the long-term capital gains that you calculate in chapter 12A versus the long-term capital gains that you calculate in 112A. In the case of 112A, students, although you don't give any conversion and reconversion concept is not applicable in 112A, but more importantly, students, in 112A, students, there is a 1 lakh exemption that is allowed. Over and above whatever is the capital gains, on that 1 lakh exemption is allowed. This 1 lakh exemption is not allowed in the case of any other long-term capital gains which is calculated in any other chapter. So in chapter 12A for NRI, when you are calculating the long-term capital gains, you don't get this 1 lakh exemption the way you get it over there in 112A. So this is what it is. Now, by the way, which is a specified asset which needs to be transferred? So the specified asset that needs to be transferred is the shares of the Indian company. Now, the deposit, students, that they are talking about it, that deposit or the debentures, as the case may be, that is also a specified asset, but provided it should not be of a private company or a closed-held company. So only then this such deposit or the debentures, as the case may be, if it is not of the private company, then and only then, students, then and only then we will say that it is a specified asset. So if it is of private company, it is not a specified asset. I'm talking only about the deposit, by the way, students, deposit or debentures. Shares, it could be of anyone, doesn't matter. But so far as deposit is concerned, it needs to be of the public company. Apart from that, there are some government securities also which can be considered as a specified asset. Now, if the non-resident Indian NRI doesn't want to pay the 10% tax as calculated, it has the option of making the investment in the same specified asset within 6 months from the date of its transfer. It's same particular, the net sale consideration, they can invest in acquiring the same specified asset within 6 months from the date of its transfer. Failing which, there would be a consequence, and the consequence would be of what? The proportionate capital gains will become taxable. The proportionate capital gains will be taxable. This is how it goes in this regard. I hope that all of you are clear with this point now. Fine. Now the last one, which is about the FII. FII is all about the rates of tax. Now you just need to understand one thing. Wherever you have found that there are concessional rate of tax, the same concessional rate of tax will be applicable to the FII also. Like for example, students, this interest, what is the concessional rate that we have seen? 5%. So wherever there is a 5% rate, that 5% rate is applicable. What is for the others? 20%. So 20% rate is what is going to be applicable. So far as the dividend is concerned, students, dividend also we have seen the two rates. 20% is actually the rate. But I have also told you about the 10% rate. So if there is a chance of that 10% also to be applicable in the case of the FII, so be it. We will go with 10%. Otherwise, 20% will be the rate of tax for dividend income earned by the FII. Short-term capital gains, if it is a 111A case, 15%. Other than 111A, 30%. Other than 111A, it is 30%. And thereafter, the long-term capital gains, students, in this case, it is 112A. It is 10%, but that 1 lakh exemption is given, and for the remaining long-term capital gains, the rate although is 10%, for the remaining long-term capital gains, although the rate is 10%, but no indexation, no 1 lakh benefit is given in the case of other long-term capital gains, though the rate is the same, which is 10%. Though the rate is same, which is 10%. I hope that all of you are clear with this one. So this is how the things has to be closed in this particular context of the NR taxation. Now students, after this, the transfer pricing, students, again it's a practical, so I hope that you will all be wrapping it up very quickly. In the case of transfer pricing also, transfer pricing, students, again the practical particular part is what needs to be seen. Just only one particular part of the transfer pricing which I have seen in your RTP, which I'll just quickly will let you know. In the RTP, students, you have seen that NJ. Now in that particular case, there were two comparables that has been found. Now generally, whenever the ALP has to be calculated, you are given only one comparable. But in that question, there were two comparables that was been given to you. Now whenever there are more than one comparable, then what you need to do, for each comparable, you will then determine the ALP separately. And how the ALP has to be determined? First, like you have the comparable price, and thereafter you will do the adjustment relating to the uncommon factor. And once the adjustment relating to the uncommon factor is done, the ALP would be determined. So you will determine the ALP for each comparable separately. For each comparable, student, separately you will determine the ALP. And once the ALP, because there is more than one ALP, you all are aware that if the ALP size is less than 6, then you will have to do the simple average. Then the simple average is what has to be taken in that particular case of the two ALP in the question which was there. Now, if you are aware of this particular point, students, that whenever there is a arithmetic mean which is considered, arithmetic mean, thereafter what we do, we compare the difference between the arithmetic mean and the transfer price. This difference is thereafter checked with 3% of the transfer price. And if the difference exceed 3% of the transfer price, if the difference exceed what? The 3% of the transfer price, students, in that particular case, we will say what? We will say that the difference is very high because it exceeds 3% of transfer price, and therefore we will go with the transfer pricing adjustment. Whereas if the difference is less than or up to 3% of the transfer price, then we will accept your transfer price without doing any transfer pricing adjustment. However, students, if it is the NJA NJA because of which you have to determine the ALP, the ALP will be subject to arithmetic mean, And once the arithmetic mean is determined, you will not further be doing any comparison with the 3% of the transfer price. Similarly, the arithmetic mean is the final ALP, and that arithmetic mean will then be compared with what? With the transfer price, and the difference between the two is what you are going to add it back. The difference between the two is what you are going to add it back. Is that clear to all of you? So this is what you just keep in mind, this part. Apart from that, there are some secondary adjustment. Directly you see some comprehensive question. APA, you just be very careful, students. Thin capitalization, do it thoroughly. Again through a practicals. And finally the case of the dispute resolution panel. So these are the areas of the discussion on the transfer pricing, students, that you will look into it. Again, because it's a highly practical question that you will have to refer it, please ensure to go through those questions quickly and swiftly. So with that, students, we have dealt with the transfer pricing particular part, and now then I also want you all to refer to the trust taxation quickly. Trust taxation, students, I want all of you to refer it quickly, students, in this context. Now, in the trust taxation, students, be careful. Two things only are there. Two things are only there. One is the computation of the total income of the trust. That is one part of the question. And the second one, students, is the exit tax. So obviously you will refer the comprehensive question of both these things. Only one question will be sufficient. But I will discuss with you some typical adjustment relating to the total income computation of the trust taxation, the total income computation, students. Now let me get started with the total income computation, students, in that particular case. So how you do go with this one, students? This is how you all do it. In the total income, students, question, so the first is the gross receipt of the trust. Then there are some expenditure which is given to you. Now question that arises in the minds is that whether, sir, we should reduce the expenditure or the expenditure should be considered as an application of income. Now that will depend upon, you have to take a position, but whatever approach that you follow, please do ensure that you actually also write the footnote of that. You will have to ensure to write a footnote of that, students. So that is one thing that you will have to take into account. Now, if supposingly, I'll tell you, if supposingly in respect of their operational expenditure, if the ICI is telling you that there is a default of deducting the TDS under section 40AIA, or there is a default of 40A3, then the operational expenditure will be considered as an application. But if there is no default in respect of the operational expenditure in relation to their TDS, there is no default in respect of the operational expenditure in relation to the TDS or 40A3, then that operational expenditure needs to be netted off with the gross receipt. With the gross receipt, students, you are going to net it off. With the gross receipt, students, you are going to net it off. Is that clear to all of you? So you will ensure to net it off, and that will be your income. Okay, that is your income. So you will not show this as an application. This will be your income. After that, you will add the voluntary contribution. Now that voluntary contribution will be added if it doesn't form part of the corpus of the trust. If it doesn't form part of what? The corpus of the trust. Okay, that is also to be added. The third one, students, is the capital gains. The third one, students, is the capital gains. Now the capital gains, students, for the trust, you do the calculation normally. The capital gains for the trust, students, you will do the calculation normally. The way the normal calculation is done, same is also the way the calculation will be done in this case also. So absolutely no such particular aspect. You just do the calculation normally the way it is generally being done. So that is the capital gains. Like how do you do full value of consideration as expense on transfer cost of acquisition or index cost of acquisition, as the case may be, and then you get your capital gains. So that is also capital gains. The next one is the portion of the anonymous donation which is considered as the normal income. The portion of the anonymous donation, students, which is considered as a normal income. You may be aware that from the anonymous donation, 5% of the total donation, 5% of the total donation. Now, in that 5% of the total donation, your voluntary contribution will come. Your even the contribution for corpus will be considered. The anonymous donation, any case, will be considered. So these three will form part of a total donation. The normal voluntary contribution, the corpus donation, the anonymous donation, all these three will form part of a total donation. So of the total donation, 5% or rupees 1 lakh, whichever is higher, that portion of the anonymous donation is considered as the normal income of the trust. So that also would be added. So you will add all these. What is that you're going to add? Gross receipt minus the operational expenditure, depending upon whether there is, assuming that there is no default of TDS or 48(3), otherwise it will be considered as an application. When I say application, it means below 15%. When I say application, it means below 15%. And if there is no default of TDS or 48(3), then the gross receipt minus the operational expenditure will be done. Then add to that further would be your voluntary contribution not forming the part of the corpus. Add to that would be your capital gains, and thereafter the next one would be the normal that portion of anonymous donation which is considered as the normal income. So you'll take the subtotal of all these, and of that subtotal you'll apply 15% as the ad hoc exemption. 15% as the ad hoc exemption, and then on the balance portion, the exemption will be available only on the basis of the application. The exemption, students, will be available only on the basis of the application towards the charitable religious purpose in India. Now let's take upon the typical examples of the application. Now I was telling to you about the capital gains. Just consider this. Supposing the full value of consideration was 100. Cost of acquisition is say 50. So your capital gain is 50. Okay, now they are telling you that the investment that has been made in the new asset, first one they are telling you 130, and second one they are telling you 80. Two distinct cases. Now with 130, that if you want to claim an exemption, now this, by the way, the exemption, that exemption of 11 money on the capital gains loan, the exemption is under 11 money. So this is an application. So application means below 15%. So this, to get the exemption of 11 money, you only require to ensure that whatever is your net sale consideration, that much of the amount of the net sale consideration is invested in the new asset. So if you are investing that net sale consideration in the new asset, that will be considered as an eligible application. So if you see over here, in the first case, 130 has been invested in the new asset, which means full value of consideration has been invested. So you will get a full exemption of 50. So while you claim an application, on the application 50 would be exempted under 11 money. 50 would be exempted under 11 money. But if you see, the assessee trust has invested more than 100. So the excess of the investment would be considered as what? As a excess application. Now this excess application of 30, the excess application of 30, this exemption would be available under section 11(1). The excess application of 30, this exemption would be available, students, under section 11(1). I hope that all of you are clear with this one. Fine, students. So this 30 is what? Students will be eligible for the exemption. Let's see the second one. There is a shortfall in the application. So wherever there is a shortfall, so in this case, not full capital gains will not be exempt. The exemption would be restrictive. How much would be the exemption over here? Students, in this case, the 11 money exemption in the second case, you will have to recalculate. And the way to recalculate is like this. The full value of consideration, you just substitute the full value of consideration with the amount that you have invested in the new asset. So therefore I am taking 80. Cost of acquisition is 50. So the capital gains is 30. So it's rupees 30 that is going to be made eligible for the purpose of the exemption under 11(1)(a). When there is a shortfall in the investment in the new asset, then this 30 is what ultimately be available for the exemption under section 11(1)(a). Is that clear to all of you? So in the first case, when the investment was 130 in the new asset, 11(1)(a) exemption was 50, full capital gains got exempt. Over and above, the excess application of 30 also was separately eligible for exemption under 11(1). So this is the first typical case of the eligible application. Let's take across the next one. The next one, students, is about the case for the case of if you have taken a loan and out of the loan you are making the application for charitable religious purpose in India, then such application will be considered as ineligible application for the purpose of exemption. Such application will be considered as ineligible application for the purpose of exemption, students. Be careful on that point also. Okay. So such application will be considered as an ineligible application. But on the loan repayment, will that be considered as an eligible application? Yes. But out of the loan, if you are doing the application, ineligible. Now, supposingly in the last year, there was an excess application that was made. In the last year, students, there was an excess application that was being made. Whether that excess application, will it be eligible for adjustment in the current year? No. That excess application will not be eligible for any exemption in the current year. Is that clear to all of you, students? Fine. So this is how there is another particular case. One more important point which is important to be reflected, students. Supposingly a particular trust has received the income on 31st of March 2022. So students, obviously we will say that this, because it is received so late, which is on 31st March 2022, so we will consider this as an eligible application in the other case. What is that other case? When you have received the money so late, so obviously you will not be in a position to make an application in this year itself. So this year you will be eligible for the application because of this reason. What is the reason? The money was received as on the last of the previous year. But there is a condition attached to this exemption, and the condition is this, that in the next year you will have to make the application toward charitable religious purpose in India. And if there is a failure to do so, then in this case it will be considered as deemed income. So you will have to write a note on this one, students, that 31st of March receipt is deemed to be deemed to have been applied for charitable religious purpose in India, but with the condition that in the next year it is going to make the eligible application, or else it will be considered as deemed income in the next year. So this is the footnote that you need to put across. Now, apart from that, students, there is this amendment which I just wanted to talk with all of you. Students, earlier, what was the case of the educational institution and the medical institution? Suppose any educational institution or the medical institution whose gross receipt was not more than 1 crore, then such educational institution which was not for profit, or medical institution which is not for profit and were solely for the purpose of educational or medical purpose, then they were eligible for an unconditional exemption under 1023C. They were eligible for an unconditional exemption under section 1023C. So therefore, for them, exemption on application as a concept was not to be considered. They were eligible for unconditional exemption as completely in this regard. Now, the Amendment of Finance Act 2021, students, as you may be aware, they have raised the limit of 1 crore to 5 crores. but they have done intelligently. Now what is the amendment? Earlier, students, if supposingly a trust has earlier supposingly a trust had both educational institution as well as medical institution. So 1 crore was separate for educational and 1 crore was separate for medical. But now with the 5 crores of enhanced limit, you will have to take into account both of them combinedly. One example I will give it to you. Supposingly a trust is having both educational and medical institution. Then for and the gross receipt from the educational institution is say 490 lakhs. 490 lakhs and 50 lakhs is a gross receipt from the medical institution. So before the amendment, this 50 lakhs was fully exempt under 1023C because independently we used to see. But now the fact that this 490 lakhs plus 50 lakhs, so it has gone more than rupees 5 crores. And because it has gone more than rupees 5 crore, students, therefore we are going to conclude what? That this exemption is not available. Unconditional exemption is not available, which means that the exemption even for that 50 lakhs from the medical institution, even that 50 lakhs from medical institution would be available only on the satisfaction of the exemption condition, which is the exemption is available only when the application is done for charitable religious purpose in India. So this is how they are going to put it across in this particular context. Okay, so therefore just be very careful about doing the aggregation. If supposing the question is about the medical institution and the educational institution and they have got different gross receipts for both, first club them and check whether it is exceeding more than 5 crores. If it is, then exemption on application. If by clubbing, if it is not exceeding 5 crores, then unconditionally they are exempt. That is the difference between the two, students. I hope that all of you are clear with this one. So you will now take one comprehensive question from trust taxation. You will do that. And one comprehensive question from exit tax. Just do that. And that is what probably you will focus and get rid of the trust taxation in this regard. Now students, last particular point which I'll discuss with all of you is about the alternate tax regime and dividend taxation interplay together. Because this is also creates a lot of confusion in the minds of the students in this context. So let me put you across to this particular context, the last one, so that you are good to go. And I think even you can finish it off this particular part. Referring one comprehensive question on alternate tax regime, you can finish it off this particular part as well. Now students, what exactly it is in this context? First of all, students, as you all are aware, in this scenario, yes, arcade not an issue. Super 50 can not be watched today. Just watch the class today and tomorrow. And as per the guidance which I am giving it to you all right now, just follow the guidance. Like how you are supposed to do trust and how you are supposed to do the other topics. So that guidance, just follow that, and that much is sufficient. Now students, if you just go through this particular part carefully, this is about a deduction of interest expenditure under section 57. I think all of you are aware of 57. Students, 57 is about what? Wherein you have taken a loan and against the loan there is an interest payment. Against the loan, students, there is an interest payment. And that loan was taken for the purpose of making the investment in the shares of the company. So obviously the question is whether the interest expenditure, will that be allowed as deduction? By the way, that interest deduction is subject to the condition of the limit of 57, and the maximum deduction that is available is 20% of the interest expenditure. So therefore now in this particular case, students, let's have a look quickly on this particular part. I have given to you various situations over here, and on each situation, students, we are supposed to comment now. Individual HUF, who is the shareholder. individual HUF who are the shareholders over here. Now, so far as individual and HUF is concerned, let's see whether they have opted for 115 BAC or they have not opted for 115 BAC. Doesn't matter. In both the cases, the deduction of interest expenditure will be available subject to the limit of 57. But the deduction of the interest expenditure will be available subject to the limit of section 57. This is the first point. The second point, students, if the shareholder happens to be a domestic company itself, the shareholder happens to be a domestic company itself, and accordingly what this domestic company would have done, it would have taken a loan to make investment in the shares of other company. Okay, and out of that loan it is incurring the interest expenditure, and that interest expenditure it wants to claim as a deduction. So therefore in that particular case, students, just have a look. Normal provision if it is there, interest deduction to section 57, it is available. Normal means that this is not an alternate tax regime, so it's a normal provision which is there. In that, deduction of 57, deduction of interest expenditure is available subject to 57 limit. But if it is opted for 115 BAB, be careful, students, here. 115 BAB, students, after the, see what happens in 115 BAB, which is for the domestic company manufacturing. It talks about its own manufacturing business, the eligible business, and the incidental to the manufacturing business. For these two categories, you get deduction other than the block deductions, because there are many sections wherein the deductions are blocked if you have opted for 115 BAB. So other than the block deductions, you are getting the deductions of the other expenditure. So at least you are getting the deduction of all the other expenditure. So this deduction is given in respect of the manufacturing business and the incidental to the manufacturing business. Other than that, any other income which is earned by the company opted for 115 BAB, for them, students, you don't get any deduction of any expenditure. You don't get any deduction of that expenditure, and that is what it is over here. And this is taxed at the rate of 22% plus surcharge plus HEC, making it to 25.168. Okay, but if the domestic company has opted for 115 BAA, then on the dividend that it will earn from the investment in the other company, the interest expenditure on their loan will be allowed as deduction subject to the limit of 57. The interest expenditure, students, will be allowed as deduction to them. This is for whom? For those who have opted for section 115 BAA. For those who have opted for section 115 BAA. And the last one, students, dividend from foreign company accessible. Like I have invested, I am a domestic company, I have taken a loan, and that loan was used for the purpose of making investment in the foreign company. Which foreign company? The foreign company whose dividend is accessible under 115 BBD. Now, as you all are aware, that dividend which is accessible under 115 BBD, on that there is absolutely nothing, because it is taxed at the special rate of 15%. So therefore there is no question of any deduction of any expenditure in this case, isn't it? And that exactly is the point. So therefore there is no question of any deduction of the interest expenditure. The third one, students, is about the foreign company or the shareholder, and the dividend is received from the domestic company. Now obviously, students, I have told you just now some time back, if there is a foreign company who is a shareholder and they are receiving the dividend from a domestic company, they are receiving what? They are receiving the dividend from a domestic company. So just now we have seen some time back, non-resident or a foreign company earning dividend from the Indian company, then it is going to be taxed under 115A at the rate of 20% flat without any deduction of the expenditure. Without deduction of any expenditure, and that is what it is. That is what it is. And this is how it has to be considered. Now, ATM deduction, students. ATM deduction. Now ATM deduction is available only to a domestic company. Only to a domestic company. Okay. Now students, this domestic company is receiving the dividend from whom? I'm writing two companies. One is a foreign company under 115 EBD and any other company. Please understand one thing. The deduction of ATM, students, the deduction of ATM is in respect of the dividend which is received by the domestic company from its investment. Dividend that it receives by the domestic company from its investment. Now that dividend could be from foreign company or it could be from a domestic company, doesn't matter. So that is what the deduction of ATM all about. So the deduction of ATM is in respect of the dividend which is received by the domestic company from its investment. So that is what has to be considered. Now this dividend income which it has received during the previous year, meaning thereby from 1st April 2021 to 31st March 2022. So this dividend income which it has received from its investment during this previous year, this will be allowed as deduction under ATM, but there is an upper limit to it. And the upper limit is how much of the dividend that it has paid up to a month before the due date of filing of the return of income. A month before the due date of filing of the return of income, that happens to be the upper limit of the deduction, and that is how it goes in this regard. That is how it goes in this regard. I hope that all of you are clear with this one. Now students, there is one particular question that is there over here. All of you will just try to understand this data. The foreign company, the dividend, students, that has been received is as under. From the foreign company whose dividend is accessible under 115 BBD. So the domestic company, students, has received from the foreign company the dividend of rupees 100. The domestic company has received the dividend from foreign company of rupees 100. From the other domestic company, it has received the dividend of rupees 120. It has received the dividend of rupees 120. And the SSC company has distributed the dividend of rupees 80. And that 80, I told you, up to a month before a due date of filing of the return of income. So it has distributed how much? 80. Now therefore the question is, you get the deduction of the dividend which you have received. You get deduction of the dividend that you have received, isn't it? And the upper limit of deduction is how much you have paid up to a month before the due date of filing of the return of income. So here the question is, students, that this 80 which is there, this 80 which is there will be allowed as deduction from 120. That is, I should be reducing this 80 from the 120 which I have received from the other company, or I should be reducing this 80 from the dividend which I am receiving from foreign company which is accessible under 115 BBD. To that the answer is you should try to not touch. As a matter of tax planning, you should not try to touch this dividend that you have received from the foreign company, for the simple reason that this dividend which you are receiving from the foreign company will be assessed at a concession rate of 15%. So therefore try to ensure that if at all you don't get a full deduction of ATM, then your deduction preference of ATM would be first from the dividend that you have received from the other domestic company, and only in excess thereafter you will then adjust it from the dividend that you have received from the foreign company. That is how it has to be done, students, over here. So students, this is how the things has to be looked upon, and accordingly it has to be concluded. So I hope that all of you are through with this one in this context now. Now students, I have given you ample of coverage that you need to handhold it now further, in this case immediately, and before I meet you tomorrow at 11 o'clock. So trust taxation, transfer pricing, other those areas of alternate tax regime and all, these are the things that you deal with it. And I also tell you one thing, that PGBP in part A, last 2 hours in part A, this part A you will find it in my telegram channel CA Durgesh Singh. Therein you will find part A. Part A comprises of 4-hour video. First 2 hours is in Hindi and next 2 hours is in English. So therefore the PGBP also can be done. All the advanced portion of PGBP also can be done from that particular Part A video in English. Disha. Students, this last one particular point I just wanted to tell to all of you. Tomorrow students would be at 11:30 for assessment procedure penalties and the remaining topics which you want me to deal with it, that tomorrow, because since it will be the last session, so therefore I will leave it up to you what you want to. But these are the session of assessment procedure penalties all which I'm going to deal it tomorrow. Students, please tell to your friends who will have their attempt due in May 23, November 23, now that in Unacademy they can take separately direct tax subject, and that too in 100% English. Hindi is separate, English is separate. And English recording will be made available to all the students from 19th of November. So just pass on this information, and the price, as you all know, is incredibly low price, which you all know about this platform. With books you can get it in 7,500. Without books you can get it around 4,000 to 700. So that is what it is, and those students can take the advantage. It's a fully 100% recorded particular lecture in English. So therefore just pass on this information, students, to your friends who will have their attempt due in May 23, November 23. Lectures will be made available 100% in English from 19th of November. So students, I see you tomorrow then in English session tomorrow morning 11:30. I've given you ample of educate materials to be covered tonight. Try to stretch it up a bit. Do trust taxation quickly. We will finish it off. Get into confidence. Do the transfer pricing and the remaining which I have told you about, the foreign taxation and the other one. Students, by the way, one more thing, students, here in my Telegram channel CA Durgesh Singh, there is one for 50 minutes video of special class which is of international taxation theory, which is in English. GAR is in Hindi, whereas that's international taxation. I have just at 10 o'clock or so, I have just uploaded that link in my Telegram channel, so you can refer that special class of 50 minutes for the theory topics on the international taxation. So that is the special class link which I have shared with it, and I think around 40-50 minutes is the session time. You can wrap it up quickly and get yourself through on that particular point as well. In my Telegram channel CA Durgesh Singh, I have just put across that also for all of you. Okay, see you then, students, tomorrow. Okay, study hard, students. See you then. Take care. Bye.